Hello, and welcome to this month's episode of Looking Back, Looking Forward. I hope you and your families are all doing well, where the situation continues to develop. And this month, I wanted to speak about something that I've highlighted the past couple of months. And that is the idea of, as we look forward, how can we think about using this crisis as a time to potentially build some better systems? Today, I want to look at for what almost anyone in the financial sector anywhere will highlight as one of their greatest pain points. And that is money laundering, know your customer, customer due diligence, customer onboarding systems. What we in the regulatory community would classify as market integrity. Market integrity regulation is all about requirements to protect the integrity of the financial markets. In this case, to protect the markets from being used by criminals, terrorists, and others for illicit activities, or to finance illicit activities. Now, why do we care about this? Well, the first, from the standpoint of markets, is that if markets are widely being used for criminal activities, this impacts on our trust and confidence in those markets, and we use them less. If we use the financial markets and the financial system less, then we put fewer financial resources into the financial system, and fewer financial resources are available from the financial system to support activities from individuals, companies, and governments to build wider and better sustainable economies and societies. That's one reason. The other reason, of course, is that when we think about preventing crime, when we think about preventing terrorism, one of the best ways to do this is to stop the flows of funds, stop the money that goes to supporting criminal or terrorist activities. And as a result of these reasons, there has been concerted activity by regulators around the world to put in place requirements to reduce the likelihood of the financial system being used for money laundering or terrorist financing. Now, at the same time, from the standpoint of anyone working in the financial system, these requirements, know your customer requirements, customer onboarding requirements, customer due diligence requirements, KYC, AML, CDD, all of these things raise expense. These are core compliance functions and a big expense for businesses. They're also a big expense from the standpoint of acquiring customers. These sorts of processes make it more time-consuming, more expensive, and more risky to onboard new customers. And as a result, many customers, because of the costs, are not commercially viable for financial institutions or for the financial system, and the end result is they are excluded. Likewise, many individuals, businesses, and the like may be highlighted as risky. And as a result, many financial institutions around the world have engaged in processes of de-risking, eliminating customers who may raise risks or who may not justify the cost from the standpoint of commercial acquisition. The third point is that from a regulatory standpoint, regulators around the world have become very aggressive in putting in place enforcement actions and fines. Big financial institutions like HSBC, BNP Paribas, Standard Chartered, Bank of America, Bank of China, and others have had fines worth hundreds of millions of dollars or even billions of dollars for violations of money laundering or sanctions regimes. Now, it's interesting because if we think of this system, even before the COVID-19 crisis, we could say that it wasn't working very well. It was very expensive, and it was not very effective at actually preventing criminal use of the financial system. It was more effective at tracing criminals or terrorists after the fact, but not very effective at prevention. Reports from the United Nations looking into this had highlighted the very high level of expense compared to the very low level of effectiveness. However, it has really been the COVID-19 crisis that it has taken to put it forward to the possibility of using technology to design a better system. Now, how does today's system work? It's an analog system, a system designed in the 1970s, basically where regulators, law enforcement places the responsibility on banks and other financial institutions to police their behavior of customers, to identify where there may be suspicious transactions or risks of illegal activity and report those to regulators. This has led to an entire industry of compliance professionals focusing just on this activity. Very high expense in the context of onboarding customers, as well as ongoing monitoring of activities. Now, today, we have in place the technology where we can design better systems. How could we design a better system? Well, one aspect of knowing your customer is proving your customer's identity. And traditionally, that has been done by checking a paper-based ID. In many places, photocopying a paper-based ID. And we all know that that is not a very effective way of proving identity. Today, an increasing range of countries around the world are developing digital identification systems. In many cases, sovereign digital identity frameworks, which provide a much more effective way of identifying individuals. So that's step one, digital identity. Step two is linking that identity to a variety of different sources of data. Now, historically, people would have thought of bringing all of the data together in one single place. In financial services today, we would call this a honeypot, where you bring together large volumes of data in one place. That becomes a target for cyber criminals and others looking to hack, destroy, or steal. So, today we have the technology where we don't have to bring data all together into one single honeypot. Rather, we use systems whereby government departments and others, birth departments, tax departments, company departments, all keep their own records. And one networks the system to that digital identity system, which then checks the information against this different government source, golden data, in order to prove identity and to allow the simplified opening of bank accounts. What this does is we think of an AML process as risk-based, but the reality is that very rarely today is AML actually practiced in a risk-based framework. In other words, everyone is put through the same processes. Now, if we can simplify for the vast majority of people, the vast majority of companies, the process of onboarding them so that it is less costly, this means that more people will have access to the financial system. This opens up not only financial inclusion, economic development, but also a wide range of new commercial opportunities. So, that's stage one. Stage two is then thinking about how we can do the same things with corporates. There are systems that have been developed in the aftermath of the last financial crisis from 2008 to identify companies, what are called legal entity identifiers. Combine these with other processes, particularly information sharing about taxation from the OECD, what is called the CRS, or the Common Reporting Standard. Combine individual documentation with digital ownership of government data with corporate information, with tax information, and you have a much less expensive way of onboarding customers and tracking their transactions. But not only that, because from the standpoint of authorities, they are able to put together patterns of transactions, flows of money across all of the participants in the financial system. Not only is it cheaper, but it also gives, from the standpoint of law enforcement, a much better picture of where the real risks and activities lie. That is better outcome at lower cost. That is technology to redesign finance. Now, why is it happening now? Just over the past 2 months, the FATF, the Financial Action Task Force, the world's international regulatory organization on money laundering, has made a number of statements on COVID-19, on technology, on digital identity, that for the first time set the framework for financial institutions and regulators around the world to build systems like this, which can function better at achieving their objectives at a lower cost while reducing barriers to the financial system and at the same time reducing costs, enabling new economic opportunities.